A very good morning to everyone who has taken the time to join us here today. We are the Pearl Initiative. Thank you for joining us for our very first live webcast. We're honored to have you with us. We're honored that you choose to make this journey with us. And I hope that you take away as many lessons as possible from this webinar as you can. Let me briefly introduce myself. My name is Shruti, and I work with the Pearl Initiative. The Pearl Initiative is the leading and only independent nonprofit organization founded to promote the business case for the implementation of the highest standards in corporate governance, accountability, and transparency in the Gulf region's private sector. Launched in 2010 in cooperation with the United Nations Office for Partnerships, the Pearl Initiative aims to convene businesses, decision makers, and future young leaders to take the lead in promoting and adopting greater governance standards. The Pearl Initiative also engages with the wider business ecosystem in the Gulf region, collaborating with over 30 regional universities and partnering with over 40 companies to collectively drive our mission forward. We work as a think tank, and we build data by publishing cutting-edge research reports and case studies to inspire business change. I would like to welcome to this webinar Mr. Khawar Ansari. Mr. Ansari has over 30 years professional experience advising boards and senior management teams across the globe. He was previously a consultant with the International Finance Corporation and has just launched his own business, White Rice Communications. Mr. Ansari, welcome to the webinar. Thank you so much for taking the time to speak to our MSMEs about the importance of corporate governance.
Thank you, Shruti, and hello, everyone. A very warm welcome to all of you attending this event. This is our first event, as Shruti mentioned, through webinar. So we're trying this. We'd like your feedback at the end and also your questions throughout. This is a workshop. Therefore, I'm going to make you work, and you have to make me work. So please ask questions at any time. And when you ask questions, I'll make sure that Shruti is taking notes, and then she'll give us a string of questions to me that I will address throughout the hour that we have together. A little more background on me. I think it's important that, I've been an entrepreneur as well as not a consultant, but I was the program manager, the regional program manager for corporate governance for the last, for the best part of a decade in corporate governance across the Middle East in different aspects of corporate governance for IFC, which is part of the World Bank Group. If I move you to the first slide, what is corporate governance? So before I answer that question, I'd like you to answer a couple of questions. If you have a business, what's your end game? That means, where are you taking this business to? We know where it's coming from, but where is it going to? What is it going to look like when you're done with it? That's question number one. Question number two, what are the top 2 risks that your business faces? So why don't you I'll give you maybe 30 seconds to reel out some questions to Shruti on this, and then I'll answer them. Okay, so Shruti, you want me to, okay, there are no questions coming through. Okay, so corporate governance is like governance of anything. Anything that needs to be governed, then, anything that works well needs to be governed. And I think about 2 months ago, I did this very same workshop in Oman for the Pearl Initiative. And we talked about equating governance to the family, because the family is perhaps the most powerful sort of well-governed body that everyone knows. And it always works. I mean, families work much more successfully than companies in many ways, in that they stay the long haul through thick and thin. And how do they stay alive for so many years? It's because of the governance at the top, that you have different roles for the mother, for the father, for the brothers, for the sisters, for the cousins, for the grandparents, and you need continuity. And the baton is passed through families over time. So governance of companies is not a million miles away from the governance of families, and we all know about that. Let me move on to the next slide, which explains more what governance is. There are three key stakeholders in the governance of companies. First of all, they're the shareholders, people who brought in the money to start a company up. And people who have money to start a company often don't understand how to run the company. And so therefore, that's why you need the board of directors. And the board of directors' role is to represent the company represent the shareholders at the company level. So they're available at the company level to make sure that management does its job. So the board of directors' job is oversight of management and oversight of the business with management. And then reporting back to the shareholders for any issues that happen, any good news, any potential threats going forward, any trends, any change of direction that the company needs, any more cash injection that the company needs, and so on. So the board of directors' role is a forward-looking role, and it is there to support the management deliver their tasks. And the management in a company is supposed to be accountable for achieving the targets that are set and approved by the board and ratified by the shareholders. So the management reports directly to the board, but they're accountable. So if they don't do a good job, they can be replaced at any time. And the board also has to evaluate the performance of the management, make sure that they're getting the right remuneration and that they're delivering the right results at the right time. So if you go into the next slide, it just summarizes some of the things I've already said, and I'll just mention some of the things in a little more detail. That really, if you don't understand the objectives of the organization clearly, and you're not all aligned as board members, then you can't really do your work. Similarly, management should be able to understand the objectives of the organization, and so should the rest of the company. They should be very clear on where you're going as a company. What are the demands? What are the targets? So it is very important for the board to make sure that management communicate what they have to achieve in the year, in a given financial year, and what is the responsibility of each person and the accountability of each person. So the board should hold senior management accountable for what they have to do, but senior management has to hold the rest of the company accountable, not all of them accountable for everything, but specific people are accountable for specific activities. And so understanding the objectives of an organization is very important. In my experience in corporate governance, one of the big flaws I found in big companies, forget about SMEs, is that people are not aligned on the objectives. They give different definitions of their understanding of the objectives of a company. And that also, that is bound to lead to crisis. So the other thing is that, the interests of the managers and the interests of the shareholders can be different. The shareholders, they may want the company to make a lot of profit. The managers who are working in the field, who are working really in the front line, they know the economic environment, the socio-political, the socio-economic climate, the political landscape. They know what the market is like, so they know what is realistic and what can be achieved. So the managers try to keep the company alive more than profitable when you're a startup, particularly when you're a startup. The other problem and the other issues that the governance involves is transparency and access to information. So you really need to know what is happening in the company and how open is the company to allow other people to see what they're doing, to understand what their mission is, what their vision is, what their general direction is, what their successes are, what some of their challenges are. And this is very, very important for investors, because I've met a lot of investors who've said that, look, if I don't know who owns the company, how can I invest in them? So this is a dilemma. This is almost like a disease in the Middle East, especially in the Arab world, in the GCC, UAE, that people hide the ownership of the company, and the ownership comes under many layers. So the investors don't know who the eventual owner of a company is, and they're not going to invest in a company if they don't know, if they can't locate the final owner, the eventual owner of the company. Because the investors themselves are subjected to governance issues. They have to have a board they report to. The board has to report to the shareholders. And we're talking about people with a lot of money. So they have to take a lot of risks, the investors. So they need to know as much as possible about your company. So I think as a company, the first thing I would do is to look at what my competitors are doing. How much information are the ones that are receiving investment from banks or from financial institutions or from donors or from any other source? They should look at what are their disclosures, how transparent are they, and how candid are they releasing information to their stakeholders. The fourth pillar is accountability. You see, when your company starts, there's one person who's running the show. But if you start becoming successful, you soon grow to 10 people, 20 people, 50 people, 100 people. Now, one person cannot do 100 different people's jobs. So the jobs have to be shared, the accountability has to be shared, the responsibility has to be shared, the skills have to be shared. I often see at companies that, especially in the Middle East, that I've seen billion-dollar companies where one person still makes most of the decisions. So if that one person goes away, you're left with nothing. And it's almost impossible to replace one person, especially somebody who's been smart enough to set up a company over many years, keep it going for 30 or 40 years. And if they pass away or they give up the business or they move out of the business, it's very difficult to maintain business continuity. And often companies collapse because the patriarch, the person who started this, has disappeared for one reason or another. The other aspects that governance includes is to make sure that they protect the governance of the company protects shareholders' rights. Because, if shareholders don't have rights, they won't become shareholders. So you need to protect shareholders' rights and particularly focus on minority rights. Because if minority shareholders are having their just desserts and their rights are protected, then automatically the bigger shareholders' rights are protected. So eventually, companies who start their own business, especially small companies, many of them will end up being minority holders of shares once they list, once they enter a venture capital agreement or anything like that. So it's in your benefit, it's in your interest to protect the shareholders' rights and to have good protection mechanisms. And then you need codes of conduct at the company level. So as you have in the family, you can't swear at your parents, you can't misbehave in front of your parents. You have to, if there is a conflict in a family, you have to deal with it immediately, and you have to deal with it in a proper way. These principles apply at the company level, at the management level, at the director level, and at the employee level. So the other thing is that, basically, it's really important that the principles of corporate governance are enforced. And this is one of the functions of the compliance department in companies, in larger companies, not MSMEs, but to make sure that the company is complying with the policies it's stating it's adhering to. And then there are issues of independence, not just at the board level, they're across the board. It's very important to have independent decisions. So whenever in life we take a big decision, we have to make decisions without bias. So you must hear unbiased views about the direction that you want to go in. Because inherently, we have a particular preference for doing one thing or another. And if you have an independent decision, if you have independent decision makers, you understand other perspectives. So the quality of your decisions will be much better if you listen to impartial views about the decision you want to make. You can always neglect it and say, look, I disregard it. Say, look, I've heard your point of view, but I'm going to go in this direction. But I think it's always a good idea to have independent views. And that's why it's encouraged that people on the board of companies, people in the management of companies are not your relatives or not your close friends. Because if there are too many relatives and too many close friends, they will not be impartial. So there will be an inherent bias. And so you will find it much more difficult to compete. But at this stage, I wanted to ask if anybody has any questions. Shruti, could you please message and let me know if there are any questions?
Of course, I'd be happy to. I would request all the attendees to please submit their questions to Mr. Ansari in the Q&A box that is located to the right of your screen. Thank you so much.
Thank you, Shruti. So let me move on. This is going to end up like a lecture, which is not the best way to learn anything. But anyhow, let's go through the process. So we explained, like an overview, I explained in an overview the overall view of corporate governance, but here is the formal IFC World Bank view. I spent 11 years in corporate governance, and there are 5 core areas, which we've expanded to 6. The first one is when we look at a company, the first thing we want to establish is, are they committed to corporate governance? What are the signs and signals that they are committed to corporate governance? I mean, are they willing to have independent directors? Are they willing to make sure that related party transactions are being monitored? Are they and declared? Are they committed to understand that disclosures are essential? Are they committed to understand that they need to have a strategy and a business plan and board meetings from time to time? Even for an SME, you can have board meetings without actually having a formal board. You can set up an advisory board of people you know well initially, who can give you, maybe 2 or 3 times a year, you can sit together and say, this is what we're trying to do in the business. This is where we're going. These are the problems we're having. What are your views? I think it's always a good idea to do that. But in a bigger company, it's essential. The next thing to look at is board functioning. And board functioning starts off with the people on the board, the skills on the board, the expertise on the board, the experience on the board. So you need to have a board which actually can cater to the market that you're addressing. So for example, if you're in manufacturing, or if you're in tech, or if you're in travel, you need somebody on the board with that experience. If tech is an important thing, you need somebody who's a technologist or has been in tech, who has commanded that market as much as possible. If you can find somebody as much as close to that as possible. Then if the person is if you're in manufacturing, you need somebody with manufacturing experience, and so on. So you need experience. If you need to network in your business, you need somebody who knows how to network and who can basically open up your networks. If you need strategy is really important to your business, you need somebody who is competent at designing, implementing, developing strategies, and so on. So that's one thing. The structure of the board is important. The second aspect is the function of the board, is how well is the board working. So typically in a poor board, there'll be a wad of paper, like an encyclopedia of paper, especially coming from finance, which you have to read before the board meeting. And what you need to do at a board meeting, you normally have 4 hours, maybe 6 hours at most, but 4 hours is typical of a board meeting, especially for a small organization. So if you have a 4-hour board meeting, there's a lot of things to get through, and therefore you need to focus on your main priorities. An ideal board would present, ideally a board would have a year plan, a 1 year plan on what they're going to achieve at their board meetings. Like an annual plan. These are the things we have to solve this year. So, but at a typical board meeting, you should focus on the priorities and work on those. And you should try to reduce the amount of wasteful talking, because 4 hours goes very quickly. So you should focus on your key priorities. So when a board is functioning properly, it's listening to each other, and if the board cannot handle something complicated, it'll set up a board committee. So, so the function of the committee is to think on behalf of the board, present their thoughts to the board so that the board can approve what they're saying. So the ultimate approval comes from the board. So typically for the type of committees you need are the audit committee, the risk committee, and the HR and remuneration nomination committee. I can never say remuneration and nominations committee of the board. So they would be dealing with HR issues, the salaries of people, and nominating people onto the board or in senior management. The committee would nominate them, the board would choose them. Go ahead.
Yeah. I've got a couple of questions from some keen attendees that we have. So we have one that is commenting on board selection and independence, specifically that board selection may or may not help independence. What would you have to say about that in terms of board function?
Well, if it doesn't help independence, it's a poor selection, because the more independent the board is, the better governed the company will be. Bearing in mind, this comes with a rider that you have competent people on the board. You can't just put people on the board just because they're independent, but they have to be qualified members of the community who enter your board. That they have to have a track record. So if I was selecting a board, I'd want independent views on the board. I would want people who have a track record. I'm not too bothered about what their qualifications are, because the qualifications of anyone are a license to practice. There are licenses to practice, but I want to see what is their track record, what have they achieved. I'm not too bothered as to which university they've been to and how long they've studied. That's irrelevant. It's how they're applying themselves. And so board selection is an art more than a science, but it's a very important art. So if it's done properly, independence will not be an issue. Anything else, Shruti?
Yes, we also have a comment on SME management sitting on the board. So when you have a small business, sometimes high management positions within the SME tend to also sit on the board. How can this bias be prevented and help independence and fairness be achieved at the board level?
Okay, so in my own company, we have management sitting on the board, but we also have people sitting on the board who are not part of management. So when you're in the early growth stage, and we'll come to that in a couple of slides, when you're early growth stage, you will have to make some compromises. You can't be you can't have the perfect board environment at point 0 or point 1 or 2. As the company matures, you will evolve, your corporate governance standards will start to evolve. So we have to make sure that the views that are being aired at the board meeting are not based on bias. And the chairperson's role, I'm not going to say chairman, because it should be a chairwoman or a chairman. But it doesn't. More and more boards need to have women on them. So a chairperson should be good enough to make sure to eke out any bias from the discussion. They can say, "Listen, Sandra, I think you're related to the chief executive, and I'd like an independent view on this." Does everyone agree with what Sandra is saying? So I think the kind of role the chair takes is very, very important. I know this is a fact. Their role this is why the chair's role is really important. And just to put things into context, the chair of a board should speak the least, but they should also come in at really vital points for course corrections during the meeting, to make sure that the meeting is going in the right direction and it is going to meet the objectives of the organization. Can I continue, or is there another question?
No, that's perfect. And just a reminder to all our attendees, please feel free to send questions through the Q&A chat box on the right side of your screen, and I'll be happy to push all your questions to Mr. Ansari. Thank you.
Okay, so there are 4 more key areas to look at in corporate governance. One is management and the control environment. This is, how well is management doing to keep their objectives, keeping on track with their objectives? How well are they delegating, and how much accountability are they giving to people, who are reporting to them? And, how well are the teams working across different disciplines? So this is the role of management. However, the most important thing is the control environment controls the risks of the company. So first of all, the board defines the risks, the 5 key risks the company is facing, and those risks are broken down into various controls. So each control must be related to a risk. So the management is making sure that all the controls are coming up green. And if anything is not coming up green, if there is going to be a red flag, their job is to report it to the board or to the relevant committee as soon as possible, so that the board can be proactive and actually say, look, this thing is going to turn red. This thing, we're not going to have the right cash flow in 3 months' time. So the board has to attend to it now, not at the last minute. So this is the role of management and the board working together. Disclosure and transparency I've already covered. The more you disclose, the more transparent you are, the more trusted you will be by outside stakeholders, particularly potential financiers. Shareholders and stakeholder relations, well, I think shareholders are very important to you right now. Stakeholders are less of a priority right now because you probably don't have too many of them and you're starting a business, but they come into play later on. Stakeholders, like if you're an oil company, if you're digging for oil, if you're drilling for oil, you're going to ruin the communities that live there, their environment and so on. So you have to make sure that they are happy with you, and that if you're making a mess or you're just being slightly moderately destructive, you're doing something to correct that and making sure that the community is getting what they want. And then the last one is SME and family governance. We've pulled that together because all the companies in the developing market have usually been started by families or their SMEs, a couple of friends getting together, putting a company together. So their governance is also very important. So there are different issues with families and SMEs. Perhaps the most important one is succession. But also, how do family members come into the company? Now, this is a completely new and very large, extensive, expansive subject, which I can't deal with in this presentation, but it's a very important subject. And but we can help you on this, should you need it specifically. So, family governance, I mean, the main issues are succession planning, how to get families in, how to split the interests of the family and the interests of the company. Because if you want to make money, you must have the interest of the company before the interest of anything else. Because if you focus on the family and they need money and they draw money out of the company at the wrong time, you can lose your shirt. Let me move on to the next slide. Let's just discuss corporate governance for small and medium enterprises, micro, small, and medium enterprises. So as I was saying in my earlier, a couple of minutes ago, that there are stages of evolution of companies. And IFC has actually developed, this kind of training over the years, and we developed it in MENA. I say we because I recently left IFC after 11 years. So, I feel that I'm still part of them. So there are different stages. So I think the best way to look at the governance is, we had a question there earlier, is when a company is small, what do you do? And this is what you do. So, when you're in as an individual who's just, a single ownership, sole proprietorship, then you have only you, apparently, to run the company. And then as you grow, it goes into 3s and 4s, and then it goes into stage 3 when you have like 50, 60 people, and stage 4 maybe when you have 150, 200 people, and then you go public and you're looking at maybe hundreds of people in your company. So there are different types of governance challenges at each stage. So, as the company matures, you need to become, by the time you're in stage 3, you should be thinking about a formal board that meets regularly. By the time you're in stage 4, you have to already be behaving like a multinational if you want to go public. So you have to be behaving, with a lot of discipline, a lot of rigor in terms of how the company is managed. And by the time you go public, well, you'll know about it because the people who help you to go public, help in inverted commas, will, ask you absolutely everything there is to ask. I went public in the UK with my company, and it was a very, very tough road. A lot of scrutiny. So there isn't anything that you can hide or you should hide. So just some tips is when you're starting a company, although you're an individual, you should still have meetings, like phantom meetings, if you like, coffee meetings with 2 or 3 people you respect. You don't have to meet them at the same time, but to talk about different aspects of your business. I think some of the best entrepreneurs, most successful entrepreneurs already do that. That's what I've seen, and I think you guys probably do it as well. But make it a bit more formal. And go with, when you have these meetings, go with a purpose to these meetings. I want to understand how to improve that production process. I want to understand how to manage cash flow. I want to understand whatever it is. So be clear on what you want to do, and then people will be much more likely to help you. And then as the size grows, the complexity of the organization grows. So you need to start to then have all the facets of governance brought into play as you go along. If you have any questions, let me know. I'm moving to the next slide. So, with these small companies, there's a massive advantage which everyone should be aware of, especially family companies. But we're talking about MSMEs, which are usually family companies. So there's a lot of commitment. You don't have to get people to turn up to work as much as you do if it's your own company and you've got employees coming in. The people are committed. They know the foundations of the business, the foundations of the owners. So they're automatically committed. They have the same vein running through them as their family members or the people that they've grown up with. So same standards, same ethical, moral standards. That's important. And then these people, because they have a quest, so they're willing to work harder, and they're also willing to forgo profits, especially in the wealthier parts of the Middle East, where there is wealth in companies, and so they're not so sort of aggressive to get to reap the benefits of profit, because profit really comes into play when you are stable as a company. So I can think of a school system I work with in Egypt, for example. I think at IFC we've worked with them for about 12 years, and their quest was to become one of the best best school for middle income families. And the owner was a real visionary, and he started the operation. And now, I think after 11 years, they came to us for help. They wanted us to build good standards within the organization. They started with one school about 11, 12 years ago. That is about 2007. And now I think they have 17 or 18 schools and a university, and they're listed on the Egyptian Stock Exchange. So this is what can happen. That and they didn't even think about pulling out the profits, because they wanted the cash flows to stay in the company, and now they're all earning very well, and they're reaping the benefits of their hard work. So the other thing is, you know about all of this. The knowledge and experience is passed to family members. There isn't so much bias when you don't have the same blood. You tend to hold things close to your heart, and so on. And then there's certain pride about the name of the family and the businesses that are associated with it. So they have a lot of potential, these SMEs. Moving on to the next slide. Oops, there we go. Yeah, if you do a good job with the governance of SMEs, and it's not as deep a process, as complicated a process as it is for higher level companies, it'll clarify many things. It'll clarify your decision making. It'll clarify your roles and responsibilities and accountability. It'll give you much better financial management, and therefore much better financial control. And then it will streamlines business processes. The reason it will streamline business processes is because you will have the right people making decisions and the right people you're counseling before you make the decisions, and you're going with the priority question that you need to answer, rather than sitting there and talking about the whole, development of the universe. You're focusing on key issues rather than anything else. And so, if you improve the process of corporate governance, you install it, you're going to get better operation efficiency. And then, of course, you will improve the quality of board oversight. If I go to the bottom left, because the board will know their roles, management will know their roles, management will know when to come in, boards will know when to take their hands off. So typically we say the role of a board is hands off, nose in. So you're sensing the business, but you're not interfering with the business. You're not touching the business directly. You're using the management to do the direct day-to-day activities. And then you make sure that your internal audit, your risk, your compliance are really up to date and top notch, so that with peace you can sleep at night, knowing that the company is in good hands. And then, if that is the case, if you don't tell the investor, they will find out. And once they find out, and it's not right, they will find. Have I lost you? Have you lost me? Can you hear me? Shruti, can you hear me?
Yes, I can.
True. You can. Okay. So the thing is that if you're with the investor, you will. If you don't tell the investor what they need to know, they will find out. And if they find out something dodgy about your company, that is when they will switch off. And then the entire investment environment around you will start to feel, we'll hear your story through the grapevine. And so you have to be extremely careful on these factors. And this is where corporate governance kicks in for investment, because it makes sure that your books are straight, your standards are straight, that you're running the company methodologically and systematically, and with full transparency and clear vision, and with people knowing their roles. So, if you do a good job, then investors, we've done research. Well, the World Bank Group has done research. Other people have done research that, investors are willing to pay a premium. So you get better rates if you're taking a loan, or if you want to go to the market, you'll get, a much better response. And so you get much better valuations, and you get much better ratings by credit rating agencies. Moving to the next slide. Oops. So this is everything put into a nutshell. That you have the board of shareholders. So summarizing, you have governance, guidance and oversight, controlling the board of shareholders. Then you have the CEO and the leadership and direction team and the integrity and ethics. And so you have the entire thing managed, and investors would love that. Love to see that. So let's go into funding SMEs. We've talked a lot about this, or I've referred to it a lot throughout the talk. So, if you look at it from the investor's perspective, they don't really, they find it difficult to distinguish between the financial situation of the firm and the financial situation of the owners. Because a lot of these things are mixed, especially in small companies, especially in the Middle East. So the monitoring of those kinds of clients' deals, it becomes very difficult, and it becomes demanding. You can imagine the pressure on potential investors once they've given you investment, any kind of investment, how difficult it is for them to report clarity up to through their chain of command. And we don't know, what is profitability and what is growth. There's a lot of variance. And then there are relationships between firms and potential stakeholders. So this muddies the water. So, the whole thing becomes, quite difficult to clarify. And this is what I found. I was on the investor forum for the OECD some years back, the MENA investor forum. And the investor said, we'd be very happy to, invest in MENA if we only knew who owns the company and if they had good corporate governance standards. They said, all of them to a person, they said that, look, having good corporate governance is absolutely essential at every level, whether it's a mid-sized company, a large company, a small company. We need to be reassured that, these people are adhering to the right standards. And another thing that comes up is asymmetry of information. So when you have investors, you need to give all the investors the right information at the same time, rather than being giving information out in a preferential way. So I'll move on to the next slide because I've hit this thing quite a lot. So these are some of the benefits you could get, and these are researches which have been done all across the globe, and this is the one from McKinsey. I know it's in 2005, but it's still relevant. There's a big premium across the world. It's about the same. It's about 20 to 25%. If you have good standards of corporate governance, I think that's your. We can look in. You can delve into that at another time. But let's move on. So, my tip to you is if you want to get investment from, access capital from investors, you need to take off your manager's role or your owner's role, and you should put on the glasses that investors are wearing and look through their eyes and look at the world through their eyes. What are they thinking about? So they will look at your audited accounts and they'll say, hey, have these guys disclosed everything? Have they covered all their bases? Are they presenting this as a rosy picture when the picture is actually not so good? So I won't go into details, but you know how people mask information in the accounts. You can no longer do that. It will be found out within the blink of an eye. So the investors also want to know how companies' decisions are made. When I have looked at, say, minutes of board meetings, they say approved, 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 approved. But in real life, I've been on boards all over the world, and I've seen there are lots of contentious issues which are discussed and discussed and discussed. And finally, consensus is reached, but people are still not totally happy with the decision that's made. Well, not all the people are 100% happy. And when they're not happy, you should put that down, that 8 out of 10 people were fully au fait with the decision. 2 people objected, and they didn't think this had a long-term future, or something like that. Something which is not going to be harmful to you, but just to show yourselves and the potential investors that there has been a level of dissent, but we decided to go against their decision, and we took a decision. Not every decision has to be unanimous. We're not trying to have a democracy. What we're trying to do is to make the best decisions. And sometimes the best decisions are made by one person. There's one expert who makes the decision, and everyone else is wrong. And that person says, look, I'll write it down. I want you to minute this because I think you're going in the wrong direction. And 3 months later, they go and look back and say, we were all wrong. This person was right. Let's change our decision and let's move back. So it's very important to minute dissenting voices. So they also want to make sure that the proper systems are in place and that they're functioning. So they won't, in the past, they would just look at it and say, okay, are you complying with the law? Yes. These days, they will be investigating. They'll be sending people like me to investigate what your corporate governance is and how and what stage it's at. And are you really, is everyone within the company completely working together as a team? Or are they, is there conflict within, is there bubbling, are there issues bubbling below the surface? Let me move on. Next slide. So, the core principles of funding is the financier wants to know, is the accountability shared across the organization? Because if it rests only with one person, they will see that as a massive risk. Because if something happens to that person, it's the end, it's the end of the story, or at least it will delay the story. So they will want to know who is accountable, and they will most probably interview many of these people either directly or through consultants like me, who will interview these people and say, okay, these are people who are autonomous or not autonomous. And then the board, I've mentioned that, that they have to be have the right skills, the right experience, and the right expertise, and a great track record, and a complementary set of skills, so that they can meet all the problems of the organization. Then we have stakeholder management, which I've covered, and I said it's more shareholder management than stakeholder management for you. And your audit and compliance. Are you using the right financial standards? Are you using the right audit standards? And are you fully compliant with all the, do you have proper audits? Are you auditing everything, not just financial things, but non-financial things, like the degree of delegation, the level of compliance with, with the industrial standards or regulatory standards, and are there related party transactions going on within the company? Are there conflicts of interest? Are they being managed appropriately? Is there a proper strategy? Is the strategy being followed? Are there clear objectives? Are there clear targets? So all these things should be audited, and be complied to. Let's move on to the next slide. Okay, so we have 3 minutes left. I think 5 minutes left because we started a bit late. So corporate governance, in a nutshell, it's a series of systems and processes for the direction and control of the company. So, we have heard so many SMEs say, well, it's not for us, but actually corporate governance is for all companies. Because, the seeds of corporate governance are in every company. If I go to an SME, you will find, or an MSME, they'll have a manager and a worker, and then a shareholder. There's corporate governance for you happening. So why are you adhering to corporate governance? Why do you have a corporate governance structure if you don't think that corporate governance is relevant? So you have to ask yourself sometimes those questions. And there are many advantages to corporate governance when raising capital. That you have to be much more strategic as an organization, and you need to carry out managerial roles in a very effective way. You need to delegate, and you need to make sure that you're executing day-to-day activities, very effectively, efficiently and effectively. If you optimize your corporate governance at the SME, MSME level, then, it's more SME than SMEs, to be frank. But at that level, then you optimize operational and financial efficiency, as I've shown you earlier. You improve the management of internal controls, and you minimize the probability of key issues such as fraud. So key risks, you're mitigating key risks. You're being proactive rather than reactive, and this will pave the way for growing the business, because you need to grow from a strong foundation, not a foundation which is cracked underneath. And then you will be able to access finance at lower cost of capital. Plus, the financiers will come to you much more easily than if you don't have good corporate governance. And also, it'll attract additional investors, particularly when you're going to float. Over to you, audience, if you have any questions. It's been a pleasure talking to you. I think we've covered a lot of areas, but it's over to you now. Any questions you have? Shruti, please let me know.
Sure. So thank you first and foremost, Khawar, for being here, for walking us through all the principles of corporate governance and the value that they hold for MSMEs. I think we've learned a lot, especially in terms of funding. In the past, the Pearl Initiative has conducted an extensive survey on the core concerns that MSMEs have in the Gulf region, and the top priority, unsurprisingly, was funding. So while I wait for the audience to push a couple of questions your way, do you mind if you and I engage in a little question and answer session?
Not at all. Please go ahead.
Perfect. So I'd like to begin by asking you, what is the most common feedback that you can give an MSME when they are announcing their desire to expand operations?
Okay, so a simple thing is the elevator pitch. You need to be able to tell your story where you
I'm so sorry for that. Mr. Khawar seems to be experiencing some technical difficulties, but in the meantime, if the audience can push their questions through, I'd be happy to communicate them to him as soon as he gets back online. In the meantime, I'd like to give the audience a little rundown on some of the activities that we hold here at the Pearl Initiative for MSMEs across the Gulf region. As I mentioned in my introduction, we are a for business, by business organization catering to stakeholders across the Gulf region. And we have a program titled Corporate Governance for MSMEs, which was launched in 2017. The survey that I spoke of very briefly earlier, where we identified funding as the top concern for MSMEs across the Gulf region, was identified as a part of this program, and the results of the survey are available on our website as a report on Gulf business competitiveness. We also regularly hold events catered to MSMEs, people who are employees with MSMEs.
Okay, so I got cut off. Excuse me, Shruti.
Welcome.
Shruti, I got cut off again. So I've just come back. So could you repeat that again, or were you repeating what I was saying?
No, I was just giving our audience a little rundown on the activities that we hold for MSMEs here at the Pearl Initiative. The question that we had for you was, what is the feedback that you can give MSMEs when they announce a desire to expand their operations? And you were talking about an elevator pitch.
Right. I think that's one of the things they must have. There are many other things, but they must have an elevator pitch. So that means that they've thought through their entire process, and they know it so well. They've scrutinized it. They've looked at it from all directions, so that they're clear as night and day as to where they are, where they were, how did they start, where they are, where they want to go, how they're going to get there, and then be ready and prepared to answer all the challenging questions that investors will pose.
Perfect. One final question, as I do see that we're approaching the 1 hour mark. Could you perhaps provide a case study where clear communication and internal structures within an MSME helps them increase their revenues or expand geographically?
Could you repeat the question again? Just repeat the question one more time.
Sure. Would you happen to have a case study, a successful MSME that used clear communication and internal structures to increase their economic and geographic footprints?
Yes, I can. If I use the school, because we're familiar with that, I've got another one, but it'll be a long story. So let me just complete the school story. The school, it was just one school in Egypt in 2007. But they're so passionate about having middle school. One thing that they did is that they eliminated the need for books, because they got a grant from USAID to actually put all their software, onto a computer, onto a motherboard that they included in their own school computer. So the kids didn't, to this day, they still don't need they don't need to buy books, because all the information is on the computer that is sold to them for $100 to $200. These are middle-income kids from middle-income families. And so IFC really fell for that and then said, okay, we're willing to support you, because they know IFC doesn't normally support very small companies, because it costs too much to, there's too much overhead cost for the SME to bear. So they'd have to go to a middle person before IFC comes in. But in this case, they made an exception, and they helped the school because their story was so good, and they were able to get lots of money. And another example comes to mind is we worked with a company called EG Trans, which is in the transport business in Egypt, in Cairo, and the father died about 3 years ago. So the daughter had to come in, and we helped them improve their corporate governance standards, and then they're now listed on the Egyptian Stock Exchange, and they're delighted, and she's just done a fantastic job. So we gave her what I've been talking about for the past hour, but we methodologically went with them and helped them build their corporate governance standards over one or 2 years. So I think that these are two examples. But I have a publication which is called Success Stories. You've got a copy of that, Shruti, I think, but I can send you a link. It's an IFC publication, which is authored by me.
All right, perfect. We would love for you to send a copy, and for any interested parties, I would be happy to circulate the IFC publication with you as well. So thank you very much, Khawar, for joining us and for walking us through the importance of corporate governance for MSMEs, and more specifically for funding. We hope to host many more events and activities with you, and we are also looking forward to launch more webinars across our other program offerings. Should any of you wish to get in touch with us at the Pearl Initiative, please feel free to visit our website, www.pearlinitiative.org, and get in touch with us. We'd be happy to get back to you as soon as possible. Thank you so much for being here, and hope you have a lovely day.
Thank you, everyone. Pleasure to present. Bye-bye.